Okay, real talk. Stop scrolling for just a second. I mean, seriously, put the phone down for 10 minutes because what I'm about to tell you could literally save you thousands of dollars every single year. You know how your whole life people told you, just work hard, pay into Social Security, and when you retire, it'll be there for you, right? And so you did. You showed up. You paid in. You did everything right. But here's what nobody told you. The government? They're taking a massive chunk of that money right back. And I'm not talking about a little bit. We're talking up to 85% of your Social Security benefits getting taxed. 85%. I mean, let that sink in for a second. And the worst part? Most retirees have absolutely no idea this is happening to them. They just see a smaller check and think, well, that's just how it is. But it is not how it has to be. Here's the thing, and this is why I made this video. There are 5 specific bills, penalties, and loopholes that most retirees are quietly overpaying on right now in 2026. But every single one of them, totally fixable, legally, today. So stay with me, because this is probably the most important few minutes you'll spend on your retirement finances this entire year. Let's get into it. Now, before we get to those 5 bills, you need to understand why this is happening. Because once you get this, the rest of the video is going to make complete sense. So, back in 1983, yeah, that's over 40 years ago, Congress decided that wealthier retirees should pay some tax on their Social Security income. And okay, fine. I mean, that actually sounds somewhat reasonable, right? The problem is, they set these income thresholds, like $32,000 a year for married couples, and then they just never updated them. Not once, in over 40 years. Think about what that means. Back in 1983, $32,000 was pretty solid money. But today, after decades of inflation, that's basically a middle-class retirement income. So now, millions of regular, everyday retirees, not rich people, ordinary people, are getting hit with this tax that was originally designed for the wealthy. You know what financial experts call this? A stealth tax, because it quietly crept up on you, while everything else, bread, gas, rent, healthcare, all doubled and tripled in price. But the tax threshold just sat there, frozen in time, pulling more and more retirees into the trap. Now, here's some good news, and I want to give you this before we move on. There's actually a bill in Congress right now called the You Earned It, You Keep It Act that would eliminate this double taxation completely. It's gaining real bipartisan support, so we'll definitely talk about that at the end. But, and this is the big but, we cannot wait for Washington. I mean, we could be waiting years. So right now, today, let's talk about what you can actually do. Stick with me here, because we are about to go through 5 specific things where you're probably overpaying, and I'm going to tell you exactly how to get that money back. Some of these are one phone call, some are a single form, and one of them could save you over $1,000 a year starting this month. Let's go. All right, number 1. And this one drives me absolutely crazy because it's so easy to fix, is your property tax bill. You know, most states in America have what's called a senior homestead exemption, or a senior tax freeze. Basically, once you hit a certain age, usually 65, the government says, okay, we'll reduce or even freeze your property taxes. But here's the thing, they don't just apply it for you. You have to go claim it. I mean, think about that. The benefit exists, the money is sitting there waiting for you, and most people just never know to ask. Let me give you some real numbers. In Texas and Florida, seniors can save anywhere from $3,000 to $5,000 a year just by filing a one-page form with their county. 1 page. In Georgia, some seniors qualify for a complete exemption from school property taxes, which is often the biggest chunk of your entire tax bill. In Illinois, there's a circuit breaker program where you can get a refund check just for being a senior homeowner with a limited income. And here's the kicker. You can probably file amended tax returns going back 3 years and get refunds for what you already overpaid. So your action step for this one is simple. Google your state name plus senior property tax exemption. Find your county assessor's office, call them, or go online. Fill out the form. That's it. You're done. I mean, a phone call worth potentially $3,000 to $5,000? That's a pretty good return on your time. Okay, number 2. This one is probably the most slept on thing in retirement finances. And if you recently retired, like in the last year or 2, this is especially for you. So, you know how when you're working, your employer automatically withholds taxes from your paycheck? Right, the government gets its cut before you even see the money. Well, when you retire, suddenly you're in charge of making your own estimated tax payments. And a lot of newly retired people, totally understandably, mess this up the first year. They underpay, and then the IRS sends them a penalty. Could be $300, $400, $500, sometimes more. But here's what the IRS doesn't advertise. There is a specific waiver for people who just retired. It's called Form 2210, and there's a section on it specifically for people who are 62 or older and retired within the tax year. If you check that box and explain your situation, that penalty can just disappear. Gone. You're not automatically entitled to it. You have to file for it. But most people who qualify get it. I mean, the IRS literally has a built-in, you just retired, we understand, here's a break provision. And the vast majority of retirees have absolutely no idea it exists. If you got hit with an underpayment penalty in your first year of retirement, pull up Form 2210, check the retirement exception box, and either file an amended return or contact the IRS. It's not complicated. Number 3. And this one, I'm going to be honest, makes me a little fired up. Because this is just the system being genuinely unfair to retirees. You know that Medicare Part B premium that comes out of your Social Security check every month? The standard amount right now is $185 a month, roughly $2,220 a year. That's already a lot. But some of you are paying significantly more than that, and you might not even realize you shouldn't be. Here's why this happens. Medicare calculates your premium based on your income, but not your current income, your income from 2 years ago. So if you retired last year or the year before, Medicare is still looking at your old working income, which was probably much higher, and charging you a premium called an IRMA surcharge. That surcharge can add hundreds of dollars per month to your Medicare bill. Now, the fix is something called Form SSA 44. It literally stands for Medicare Income-Related Monthly Adjustment Amount, life-changing event. And retirement? That counts as a life-changing event. You fill out that form, you report your current retirement income, and Medicare will recalculate your premium based on what you actually earn now. I mean, we're talking potentially over $1,000 or even $2,000 a year back in your pocket, just from one form. You can get Form SSA 44 from the Social Security Administration website or at your local SSA office. Totally worth the hour it takes. All right, I want to do a quick bonus round here because it's that important. Where you live in retirement could be costing or saving you a fortune. You know, a lot of retirees just assume their state taxes work the same way as when they were working. But retirement income, Social Security, pensions, 401k withdrawals gets treated very differently depending on the state. For example, Pennsylvania doesn't tax Social Security, pensions, or 401k withdrawals at all. Zero. Illinois doesn't tax most retirement income either. And Iowa just made all retirement income completely tax-free for residents 55 and over starting in 2025. If we look into another side, states like Minnesota and Vermont will tax your Social Security once your income crosses certain thresholds. And some retirees are paying state taxes on their pension income even though their state specifically exempts it, just because they never knew to check. So here's what I want you to do. Google your state's name plus Retirement Income Tax Exemptions 2026. See what your state actually allows. And if you've been overpaying, most states let you file amended returns for the last 3 years and claim a refund. This alone could be a $2,000 to $4,000 conversation, depending on where you live. Okay, last one. And this one is more of a long-term strategy, but it is probably the single most powerful move available to retirees who want to protect their Social Security income permanently. It's called a Roth IRA conversion. You know how the IRS taxes your Social Security based on your total income, what they call combined income? Well, here's the thing. Money sitting in a Roth IRA does not count toward that formula. It's completely invisible to the Social Security tax calculation. So if you have money in a traditional IRA or a traditional 401k, and you convert some of it to a Roth IRA during your early retirement years, before you hit 73 and have to start taking required minimum distributions, you are essentially moving money out of the IRS's reach, permanently, legally. That's not a trick. That's just understanding the tax code. Yes, you pay taxes on the conversion in the year you do it, but in exchange, you get tax-free growth forever, tax-free withdrawals forever, and you lower your future required minimum distributions, which lowers your combined income, which lowers or even eliminates your Social Security tax. If you do this right during those quiet income years between retirement and age 73, you could potentially make your Social Security 100% tax-free for the rest of your life. This one is worth sitting down with a tax professional or a fee-only financial advisor for. It's the kind of move that can be worth tens of thousands of dollars over a 20 or 30-year retirement. Look, you spent 30, 40 years getting up every single morning and doing the work. You paid into the system. You played by the rules. You deserve to actually enjoy what you earned. And you're not going to get it by waiting for the government to fix a 40-year-old problem.